Hey, David, how's it going?
Hey, good. Thanks. How you doing, man?
Good. We are in the throes of fall here in Cleveland, Ohio, enjoying the chillier weather. I started soccer coaching for both my girls. It's been good. How about you guys?
Very nice. Yeah, it's back to school here, and our community pool is closed, and we were at an apple orchard over the weekend. So yeah, it's definitely fall season here in Michigan as well.
Lucy had off of school today, and that's actually where I was all day. We were out at the apple orchard, so that's a popular Midwest event for us. It's good stuff.
Yeah, yeah. And how about on the real estate side? You've been busy there?
Busy-ish, yeah. It's kind of a weird time right now. I've got a couple investor clients that I'm helping finalize some deals. Should be closing on one this week, which is great. Um, on my own personal investment front, we were vetting some interesting deals this week, but nothing that's going to really pan out. But it's been fun to look at stuff. It's hard with the current rates. I mean, the rates are just making things tough, but it's still doable. Just tough.
Yeah, it feels like it's looking at different kinds of deals, making sure that it's got a lot of margin in there
Mhm.
to offset that higher payment that would be there, or trying to find a house at a lower price or something like that. Yeah, for us, one of our most recent ones that we're on right now is a pretty serious rehab project. So trying to create some equity that way. In fact, working with a partner on this one that I've worked with before, and that's been fun too to try to work through just the construction aspect of things.
Yeah, I like that strategy. Not only the construction and the rehab, creates some affordable housing for some people. I think that's a huge part of what we do. But the partnership part is great because it spreads out that risk. It can make the project more fun too. I know in the projects that you and I have done together, like I don't know, it's a lot more enjoyable to have somebody to commiserate with the problems and celebrate the wins on. So that's partnership is a good thing. That's awesome.
Yeah, it's worked out really well in this one too, because in a project that requires more construction work, that requires more attention, and
Yeah.
so I'm in a place where I can't really be present in the day to day because I don't want the real estate work to interfere with my job as a pharmacist. And so working with a friend who's super talented in that day to day management aspect has made this move along so much faster. Like I can't imagine if it was like I have to return every call from everybody that's working there, but I can't do it until the evening and nothing moves on versus he's able to just take calls and keep things moving. And that's fantastic. And on his end, he has said before that he doesn't like the deal finding and the spreadsheets and all that stuff, but that's all stuff that I can do in the evening. And it's fun for me. So it creates a really fun win-win.
Yeah, especially for again, most people listening to the show, right? Probably busy pharmacists. It's a great way to use partnerships to find some success or to even start investing. And you've given other examples in the past too, where maybe one partner brings the deal and the other partner brings the money, or one partner has the construction skills and the other partner has the deal finding, right? And so there's different ways to use that partnership, and you don't have to necessarily have the money or the skills or whatever to get into the game. You just have to have one of those pieces and then let somebody else bring the others. And it's a great way to jump in.
Yeah, and like you said, there's lots of different ways for that to work. Like we had Senate back on episode 53, and he's one of those examples where he brings the deal and he brings the knowledge and he brings a lot of those things. And he even brings some of his own money, but then he looks for people that have other money as well because he's doing some really big deals. And so, that's one way to do it. But there's certainly ways. We haven't talked as much about ways to get involved with real estate when you don't have as much money, but that's also something too. I know you shared before that you jumped in when you had a lot of student loan debt and not a lot of cash,
Yeah,
right?
exactly. I Our very first deal was that way. I wanted to get in. Still had a huge amount of student loan debt. It was really difficult to build up that larger down payment, but I had the skills. Right, I'd been a real estate agent for years. I had the deal finding, so brought in a silent partner, my brother actually, to be half the cash. Right, and that was a great way for us to partner up and get success together. And so again, just using what I had available to me to make sure that I could keep moving forward.
Yeah, one of the things, we like to stop every few episodes and do some of these deep dives where we talk about topics that come up frequently in the YFP real estate investing Facebook group or in other questions that come to us, and one of them is getting into real estate when you don't have a lot of cash. right? And so partnerships are one great strategy for that, partnering with other people, combining funds, and doing that together, particularly as we see the price of real estate continuing to climb right now. It is a tougher time to get in if you don't have a lot of cash, but there's also several different strategies to make that work. So we wanted to spend some time and break down some of those strategies today, namely living in your investment, which is one way to go, creative finance, which we can define that and talk about that in a minute. And then we'll end with partnerships, which is kind of where we're starting here, that partnerships can be one way to do that as well.
Yeah, and David, I know you are a great example of someone that kind of has talked before about moving into the properties that serve as investments for you. So, can you walk us through maybe what that means or what that might look like? I know there's a ton of examples. We could spend a whole episode just on this, but if you're talking about living in your investment, what does that mean to you? What does that look like?
Yeah, I think living in the investment, and I don't know that we did this super well in our first one. I think that we learned a lot of lessons on our first one, but my wife and I bought our first house. It was an FHA mortgage, and it was a property that needed some work. So with an FHA mortgage, that's the 3.5% down, and so if I remember correctly, we were able to buy this house for I want to say $5, $6, $7,000 out of pocket, something like that, because if I remember correctly, we rolled some loan costs into the mortgage. There's some flexibility with all of that. And so if you're not looking for a super expensive house, which is what we were looking for as a house that needed some work, that was fine for us. And we were in a season of life where we didn't have kids. We were okay buying a dirty house that needed some love. So it was dirty. It needed paint. It did not smell good, but it was a solid house. And that was what mattered, because cleaning and paint and all of that can help with a house that literally smells like dog urine,
Oh
right?
boy.
Like you can get rid of those kind of things over time. We didn't want there to be like bad foundation or bad roof or something like that. And so we were able to get that place cleaned up drastically for like maybe $1,000 in paint and some new carpet and some cleaning supplies.
And something important, I think you mentioned there that it's a misnomer when we start talking about these things. How do you invest with little money down or little money available? It's not no money, right? There are absolutely ways to do this with absolutely no cash whatsoever, but it's really difficult to actually achieve that. And so what we're trying to talk about and what you're focusing on there is that it was a little bit of cash up front to be able to jump into the game. And I think that's super important. It's reasonable for pharmacists, especially, to be able to save that little bit of money here and there to get to that point where you've got just enough for that down payment and just enough to make that rehab cost work, and it doesn't cripple you financially, right? So that's an important caveat. These are not examples where you're just going to jump in with nothing in your pocket and hope for the best. You still want to come from a place of financial strength, but these are tricks to get into that game earlier with less money than you typically would require for an investment property.
Yeah, absolutely. I feel like there's a lot of just kind of clickbait out there about how you can jump into this with literally $0. And that makes me nervous, because even once we had this house fixed up, and our my wife was pregnant with our first child, we brought our first child home from the hospital, and that day the furnace
Oh,
quit.
geez.
So like there's even those just kind of life things that, whether it's an investment property, whether it's your own house, like there are unexpected expenses that can come up. And so like you still need to even making sure that you're not spending your very last dollar on that last can of paint, thinking that that's going to be the last thing. Like it is a house, and there can be things that go wrong in that property.
So you bought this place. It smelled terrible. You needed to paint it up. You're getting it all fixed up, ready for the new baby to come home. But where in that does it become an investment, right? Where are we turning the corner from, house that you and your family are living in to this is now an investment property that I've been living in for a while?
Yeah, I think that's a great distinction, because there's probably a lot of people that are jumping into houses that smell like dog pee, or they go through and they like, for us, we had to pull out the carpet and like, seal the subfloor and put new carpet down and stuff like that. But I think there's a lot of people that do things like that and may not give themselves enough credit that they're living in, and they're putting in that sweat equity to create some value, create some equity in that house, and create a better financial situation for themselves. And so that starts looking a lot more like an investment in a few different situations. The first is if you're going to at some point turn and sell that house for a
Mm-hmm.
profit. So if you're going to flip the house that you're living in, which is more of what we did. The second scenario is house hacking. And the third scenario would be moving out and keeping that property as a rental and letting it be an investment property for you. I think we could maybe talk about house hacking for a
Sure.
minute because we've talked about that a lot on recent shows. Um, Bryce back on episode 10, I think was one of the first that brought house hacking into this podcast, but really buying a house and then renting out portions of that house or units in that house, however it's built, to
Mm-hmm.
roommates. That's one way that you can generate some income in the place where you're living. But my wife and I, in a 3-bed, 1.5 bath house, as we were, looking to like that wasn't really a fit for our season of life as we're welcoming our first baby into the world. That wasn't what we wanted to do. So it's a great strategy if you're willing to do that, but it may not fit every season of life for every pharmacist out there.
And what about you mentioned you sold this first one for a gain though, right? So is I think most people when they think of flipping, which is what you're alluding to, it's you fix it up, you put all these nice fancy finishes on it, and then you sell it on HGTV for $500,000, right? So does that have to be the case? Like, what were you guys doing with this particular property?
Yeah. So for us, we ended up keeping it for a while. There is a rule right now, and I'm not an accountant or an attorney, but there's a rule right now that vaguely says that if you keep a property, you live in it personally for 2 of the last 5 years, then there's a substantial amount of gain that can be had where you do not pay taxes on that
Yeah.
gain. So again, if you're in this scenario, talk with a tax professional or an attorney and make sure you've got all your ducks in a row for that. But there's ways that by living in that property and by staying there for at least 2 years, there can be some major tax advantages when you go to sell. And so that was more of our plan of let's buy this house relatively inexpensive, fix it up, enjoy those fixes, live in it during that season, but then sell it at some point for a gain and let that gain be the investment.
And the last way that you mentioned there was the turning it into a rental property where basically you just move out and start renting it out. I think a lot of people do this. They call themselves accidental landlords, right? Where you move out and you just keep the house and start renting it, right?
Yeah, and that was really our next step. We wanted it to be a little less accidental, a little more
Mm.
intentional. And so we ended up the second house that we bought. We did a similar thing where it was pretty trash. It was more trash than the first time. Like one of the benefits of doing that very first live-in flip, where even though we didn't make a ton of money at the end on the sale, we at least knew the kind of things that we could do. We felt comfortable doing, where we could hire someone, how to hire someone, how all that could be done. And so that gave us some boldness to get something that was a little more trashed in that next house. So we did that. We bought that property. And then we bought that property now, having done a little more homework on the rental side, knowing that, okay, if we move out and if we keep this
Mhm.
house as a rental, it will have good rental numbers. And for us, it worked out tremendously well as a property where our monthly payment was something like 600 a month, and we were renting it for like 1,300 a
Oh,
month.
wow. That's
So
great.
we've talked many times about how that difference between 600 and 1,300 is not your cash flow. There's a lot of other expenses, but even factoring in those other expenses, it ended up being a very solid first rental property for
Yeah,
us.
it's awesome. And again, you doing that first place, living in it, flipping it slowly, but flipping it, it gave you the
Mhm.
confidence, the experience to be able to do that. So you, like you said, you knew what to look for, you knew what moves to make, and it sets you up for what turned out to be a great rental. That's awesome.
Yeah, and again, just from that first 3.5% down on the first property, just by letting that work over time, that allowed us to get there. So it was a relatively low cash out of pocket strategy to get our feet wet. Um, but again, that's one way that this can be done. I think Nate, your story is a little different with creative finance. So could you walk us through a little bit of the creative finance and how some of that can work, or how pharmacists harness creative finance in today's market?
Yeah, and there are lots of examples of creative finance. Like that's a big umbrella term for just some of the ways that you can do this. But yeah, so if you talk about one of the simplest approaches to creative financing, it's working with what we call a private lender, basically someone that isn't held to those conventional lending rules. like I said, for me, it was my brother. It could be anybody. It could be a friend. It could be a family member. And that loan doesn't have to be a number, a certain amount. It can be $100,000. It can be, $1,000 in some cases, right? You can have private lenders that vary in size and scope based on what you're trying to do, the level of fixing up that you need to do, whatever that looks like. That is a way to get creative with your financing.
Yeah, and we should probably pause for a minute here too, because from the mortgage side of things, there are rules where if you're trying to buy a property with a mortgage, but then you're also doing kind of these creative finance things simultaneous, that there's rules where that can get a little messy. Is that right?
Yeah. So again, not a lender, but definitely some rules there, right? So if you're borrowing money from somebody, there are restrictions on what you can do with that money. For example, I usually cannot use that as a down payment without disclosing it like crazy, right? So if it's a gift from somebody, let's say I'm buying the house and my dad is going to gift me $10,000 toward that property, my father would have to disclose that. There's a lot of signatures that have to take place, basically showing that this is not a loan, this is a gift. And again, if the intention of what we're talking about is creative financing, then that's not the case, right? You're borrowing from somebody with the intention of paying it back, and the bank doesn't want you borrowing to borrow, right? So there are rules, there are restrictions. As you've said in the past, one of your best bets is to talk with your lender before doing any of this stuff, and make sure that it's appropriate. So like I said, with my example, when my brother and I went in together, we had a partnership agreement. We disclosed that to the lender and bought the property together. It wasn't like he was just giving me money on the side and we'd kind of not tell the lender about it, right? We were really upfront, and disclosed all of that so that it was really clear.
Yeah, and that makes it, all those hoops and things you have to jump through with borrowing and gift funds and some of those things that can be a little tricky. Certainly can be done, but can be tricky. I think one thing that is, as you and I have talked with a lot of investors recently, one of the things that I'm hearing in this market in particular is people are seeing their home prices appreciate and they're finding equity in their house as people using home equity loans or home equity lines of credit as a way to speed up their investing. So, can you walk us through that one for a minute?
Yeah, absolutely. So, very briefly, a HELOC or line of credit versus a home equity loan. The difference is that the line of credit is kind of like a credit card. It allows you to tap into the equity that you've built into a home, whereas a home equity loan is more of a lump sum of cash you're receiving from the bank. You're using that for whatever you'd like to, but you're paying that back over a longer period of time. And so there's a lot of pharmacists out there that have probably bought a home years ago, others as well, that house is then appreciated. So maybe you bought a $300,000 home that's now worth $450,000, meaning that even if you didn't put anything else into that home, there's $150,000 worth of equity there. And a bank might be willing to lend on that equity up to 80 or 90% of that total value. So it might be possible to borrow up to, let's say, $100,000 from the bank, from yourself, basically, on the equity that you've built into that house. And it's a great way for you to tap into the equity that the market has basically given you just by owning that home for that long period of time.
Yeah, so that $100,000, assuming that there's, you're allowed to use that for purchase or renovation, and there's no restrictions from the bank. Again, make sure you're talking all this through and sharing all this transparently, right? But if that may be a great way to help with rehab costs, or maybe in some cases the entire cost of a rental property, depending on how much equity you've accumulated in your
It's
property.
one of the huge values or the biggest advantages of a long-term hold with a property, right? Is that you're gaining equity on that property without really doing anything. And you have the ability to access quite a bit of capital without really having to save it up, which is a nice advantage. We actually used our HELOC earlier actually the end of last year. We purchased a property in cash and we used a HELOC to basically do all of the rehab and waited for us to refinance that 6 months later and then paid back our HELOC again, just like a credit card. The nice thing about this credit card is that it doesn't have a 20% interest rate on it, right? It's going to match mortgage interest rates. So getting a borrowing from myself at 4% at the time was, like pennies compared to what I could do on a credit card or something. So it's a nice way to, again, use that equity that you've already got somewhere else and not have to save up all that cash.
Yeah, I'm sure people heard the credit card analogy and they thought why would I borrow at 20% interest,
Right.
right? Yeah. So especially the YFP audience that is trained to hear those numbers and say, no way. But I think in fairness to some of the risk in this too, I think we should say that this does then create debt on, in this case, if it's a HELOC on your primary residence, it would be debt on that primary residence. So if something were to happen and you weren't able to refi, or something bad happened to that investment, you would just have additional debt on your primary residence. And so there certainly is risk. This isn't just like free money that appeared out of nowhere. Like there is risk to all of this, but that can be one creative way to access cash without, like you said, having to save up cash on a monthly basis.
Absolutely.
So then we've covered living in your investment, which is nice from a low cash investing standpoint, because there's lots of options for very low down payment, or even in some cases, zero down payment loans to buy a property that you live in, whether that's a single family house that you eventually sell or you leave set aside as a rental someday, or maybe that's a multifamily property or a single family house that you're house hacking, something like that. So that's that option. There's creative finance with, borrowing money from, friends and family might be one way, or home equity might be another way. That brings us to a third option, working with a partner.
Yeah. And like we mentioned earlier, there are a ton of different ways that you can bring value to the equation as a partner. Some of the ones that come to mind immediately, I mean, you can hustle to find a deal, right? There's always that deal finding side. We need to find a deal to have a deal. So that finding is a tricky part. Maybe you're just flexible in your job. Maybe your hours are, you're a 7 on, 7 off pharmacist. And so for one whole week, you can be on the site to manage construction or meet with contractors or attend the closing, or all the different things that need to be done on a bigger project like that. And so don't just think about it for the money, right? That it's not just about having half the capital and that's all you can bring to a deal. There are a lot of other pieces that you can bring and bring a lot of value to other investors that might have different experience or that might have different connections that you don't have.
Yeah. And I think there's a lot of instances, kind of like you explained with working with your brother, where two partners may individually have some money, maybe not enough to jump in individually, or maybe even have enough, but just don't want to take on all that risk themselves. Right. Just want to go it with somebody else to learn together, so that there's less risk if you're sharing in that risk. And there can certainly be ways that partnerships are set up where maybe both partners are not doing half the work or bring half the money or take half the profit. There can be ways that you can work with someone else where there's even a different split. Maybe you have less ownership of that deal because you're bringing less of everything, but you still get to see it. You get to be a part of it. You get to learn from that. And so there can be value in all kinds of different ways in working with partners.
Yeah. And again, personally, I've been on both sides of the equation, depending on the partnership, where the value I bring is very different, right? So again, that first deal, I brought the experience, I brought half the cash. I was the one that brought the deal. So I was able to come to the table with quite a lot. But I've been on other partnerships where I just bring the money and help with the decision making, right? And just show up for that phone call, and that's all I need to be there for. So it depends, right, on what you can do and what skills you have and what abilities you can bring to the table to see what's going to be a good or a bad partnership. It's really about finding that win-win when you're working with another person or about working with multiple people.
Yeah, I think that I don't think we can emphasize that enough, that finding that win-win is what makes sense. That there's nothing that makes it essentially good if you are a 50% of something or something like that. Doesn't necessarily define good. It's, have you found that win-win where everybody is in a better position because they're working together? And certainly we've talked about on prior podcasts too, that if you are going to get into a partnership, you want to make sure that you've written down all the details. There's potentially probably legal implications there. So you may want to clarify all that with an attorney. There may be tax and accounting considerations there. You may want to talk with your accountant. So there's a lot of homework to do to make this official, particularly if you're going to form some kind of business entity, like a partnership LLC or something like that. There's a lot that you want to make sure that you're doing right, and you're bringing in the right professionals. You're getting those right consults along the way. But yeah, there are absolutely ways where two people can be in or more can be in a better situation because they've chosen to work together on an investment.
Super important though, David. It really, again, if you miss that, you can't emphasize it enough. Do the legwork in the background, right? It's not just, hey, I heard you're an investor, let's partner, and we just go off to the races. Like, you want to establish trust. You want to establish working documents that plan out everything. I mean, again, before we ever bought this property, that this very first one my brother and I had, we had all the possible exit strategies laid out and what would happen if those transpired, right? If one of us passes away, if one of us decides we want to sell the property, if we can't agree on selling the property, like what happens? That way it's really clearly defined, and we know exactly what's going to transpire. And it just take all the guesswork out of it. One of the worst ways you could ruin a deal is by partnering up with family or friends, and then that friendship or that family relationship falls apart because of the deal. You don't want any of that to occur. So establishing this stuff up front, super, super important. We cannot emphasize that enough.
Yeah, it always seems super easy to split up future profits when everything goes perfectly and the profits are enormous. But we all know that then real life happens and some of these things get a little trickier. And so, again, though, in partnerships and collaboration with others, sometimes it can also be easier to weather those storms when you have people that have those different backgrounds. Like one of the first times we did a major renovation flip, I worked with a friend who was also a licensed builder and knew in and out, like all about very comprehensive construction management. And so that was a huge learning experience for me. It was a huge weight off my shoulders to do that. And then it created a great win-win environment. So it can be done as long as you're making sure that you're doing your homework to do that right and to account for all those potential scenarios where it may not go well. And what do you do in that instance?
Great stuff. Well, those are 3 ways that you can consider getting into real estate investing with really little money invested, or not all of the money that you might otherwise need. There are many more strategies, many more things that we'll be able to cover in future podcasts. If there's anything in particular you want to hear about, whether that's wholesaling or deed buying or seller financing. I mean, again, there's 1,000 different ways you can do this. Reach out to us. Let us know. We want to hear from you guys. If there are strategies that you find interesting that we haven't talked about in the past, or you have experience in those strategies, please hit us up. You can find us on the YFP REI Facebook group. You can go to our website, www.yfprealestate.com, connect with David and myself there. All those are great places to find us. We'd love to hear from you guys. Offer up advice or offer up questions. It's a great way for us to connect and stay in the loop.
Yeah, absolutely. So those 3 strategies again from the top are living in your investment to find a low money down option to buy and move in and do something from there, creative financing, or working with a partner. So particularly as we head into a market season that appears to have some headwinds of some high interest rates and some high prices, the methodical, thoughtful pharmacist that's planning well and planning ahead may find some of these as a way to bring some safety to their investing too. So thinking all that through in advance can be really helpful to make sure that you've got a safe amount of cash in your investment as well.
For sure. Well, hopefully this helps you guys get your gears turning about ways to get creative and invest with a little less than you thought you needed. And again, if there's anything we can do to help, don't hesitate to reach out. And we'll see you guys next week.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.